Hello class, my name is Jared Mosoti from the School of Business and Economics, Department of Accounting and Finance. I'll be taking you BAF3204, Principles of Taxation. In today's class, we'll be focusing on VAT, that is Value Added Tax. Our first task is to understand what VAT is. VAT is an indirect tax that is paid by any person who consumes taxable goods or services either supplied in Kenya or imported into Kenya. Now VAT is focusing on the goods and services, and basically it focuses on those which are either manufactured within the country or which are imported into the country, but they are consumed in Kenya. For that reason, we call it a consumer tax. Then VAT has been described as an indirect tax simply because the incidence and the impact of tax are on two different persons. And because of that, this type of tax can be shifted. In a short while, we'll be seeing the meaning of incidence and the incidence and impact of tax. But before we do that, VAT is computed anytime there is an increase in value of any product. Now, when we talk about product, we mean both goods and services. Therefore, whenever goods and services change hands, that is from one person to another, through transactions of sale, the value of the goods is presumed to have taken place. And because of that, it attracts the value added tax. Now, as I promised you, we are to look at the difference between impact and incidence. In tax, impact is the first point of contact of tax on the taxpayer. Now, this means these are the persons who bear the first responsibility of paying the tax to the government. Therefore, in this case, the traders who are registered VAT members will have to bear the impact of the tax. Then incidence is the final resting place of the tax. Now, these are the persons who bear the money burden. They bear the money burden of the tax. Therefore, the consumers, the final consumers of the goods, are the persons who will bear the money burden. Now, this is done through what we call tax shifting. That means the traders will pay the VAT, but they will incorporate the VAT value in their prices, and this is transferred to the final consumers of those goods. Therefore, shifting takes place through the transactions, and by so doing, you find the liability of tax is transferred from one person to another. So if we have two people here, the trader will bear the impact, then the incidence will be on the consumer of those goods. That is the person who bought the goods. Now, in Kenya, VAT is governed by laws. Now, the laws governing VAT are contained in the VAT Act Cap 476 of the laws of Kenya. VAT first came into force in 1990, and it came in to replace the sales tax. Now, other laws that have an effect on VAT include the VAT Act 2013, which was revised in 2019, the East African Community, the Custom Management Act 2015, the Tax Procedures Act 2015, and so many others. But I've just given you this few among so many others. Now, before VAT was introduced, I've indicated up there that we had the sales tax. Sales tax was enforced in Kenya between 1973 and it was abolished in 1989. Now, why did the government replace the sales tax with VAT? Now, I have a table here for you. On one side we have sales tax, and on the other side here we have VAT. Now, this will explain the reasons why VAT was more preferred when compared to the sales tax. Now, in the first case, you can see sales tax had a lesser coverage. It was only focusing on goods, but VAT has a wider coverage. It covers both goods and services. Then it had cascading effects. Cascading here means that you will have to tax on another tax. VAT does not have cascading effect. Then the sales tax was being charged on the cost price. But if you look at our VAT, it is being charged on the selling price. Then if you look at sales tax, it was being charged at one point only. But as we are going to see, VAT is charged at various points. At any point where value is added, we are going to have VAT being charged. Then it was supposed to be claimed from the commissioner. It was supposed to be claimed from the commissioner. Then the VAT can be offset against the output tax. We are also going to see that one. Now, how is VAT collected in the country? VAT is collected at designated points by VAT registered persons who act as the agents of the government. Now, they are required or expected to charge VAT as per the effective date of registration for the obligation. Now, charging VAT by an unregistered person is a criminal offense. A person who is registered for VAT can charge VAT to customers who are registered as well as non-registered customers. Then a manufacturer can include VAT in the price of goods supplied to a wholesaler. Then the wholesaler in turn can also include VAT in the price of goods supplied to a retailer, and the retailer in turn can include VAT in the price of goods he or she supplies to the consumers. Now, you notice that the traders we have mentioned, the manufacturer, the wholesalers, the retailers can be registered VAT members, whereas the person who will bear the money burden, the consumer, is non-registered. Now, eligibility for registration. Who can be registered for VAT? Now, any person supplying or who expect to supply taxable goods or services with a value of more than 5 million shillings qualifies to be registered for VAT. Then the law also provides for voluntary registration where the threshold is below the stipulated amount of 5 million shillings. Now, if a person has supplied or expects to supply taxable goods whose value is 5 million or more, within 12 months, one needs to register within 30 days from the date on which he becomes a taxable person. Now, it is important to note in VAT, time is very important. Time of supply. Now, VAT should be accounted for on the earlier of the following dates. Number 1, the date of delivery of the goods or services. Number 2, the date of invoice. Number 3, the date of part or full payment. Number 4, the date of certificate issued by an architect or a surveyor. Then the time of supply in respect of reported services is the earlier of 1, the time when services are rendered. 2, when payment for services is made. 3, when an invoice is received in respect of the services. So I have given you those two for goods and for services. You are supposed to look at the date which is earlier of the dates which are given. Now, VAT should be accounted for when supply takes place. Now, the word supply means 1, sale or delivery of taxable goods to another person. 2, sale or provision of services to another person. 3, making a gift of any taxable goods or services. 4, provision of taxable services by a contractor to himself. 5, appropriation of taxable goods or services by a registered person for his own use outside the business. Now we look at the VAT rates. It's important to note that VAT changes from time to time, and therefore it is important at any one given time to look at the changes which have been effected during any fiscal year, which are normally presented during the budget presentation by the CS for Treasury. Now the current rates are as follows. For taxable goods, the standard rate is 16%. That is for taxable goods and services other than those which are 0 rated. And then you remember some time back we also had the cut of VAT on petroleum products by a half, and therefore a half of 16 is 8%. Therefore for petroleum products the VAT applicable rate is 8%. Then 0% applies to exports, supplies to privileged persons, or general services or goods listed under second schedule to the VAT Act 2013. 0 rating makes the supplies cheaper as tax chargeable is 0 while the input tax is claimable. Value of supply. This is the consideration for supply, that is the basis on which VAT is charged. Now the general rules of determining the value of supply include: number 1, where the supplier and the buyer are independent of each other and dealing at arm's length, the value of supply is the price of which the supply is provided. Then 2, if the prices cannot be determined, the commissioner is empowered to fix the prices. Then any incidental cost on the supply should be included in the value of the supply. For example, we have rubbers, we have package boxes, we also have containers. All of them will be included in our tax. Then if taxable goods are sold in returnable containers, the container should not be included. in the value of supply. Then the value of supply in respect of imported goods include the duty. Then the discount allowed on goods should not be included in the value of supply. Then if insured goods are lost, the insurance compensation constitutes the value of supply. Where the goods are supplied, where the goods are purchased under the purchase terms, the value of the supply is the cash price, the higher purchase price, and interest, and the interest is disregarded. Now we look at the registration and deregistration of taxable persons. Now, who can be registered for VAT? A person can be registered for VAT if he or she in the course of business has supplied or expects to supply taxable goods or services or both with a value of 5 million or more in a period of 12 months. Such a person should apply for registration. Then, if a supplier is intending to supply goods that have a turnover of less than 5 million, then such a person is supposed to register for what we call the turnover tax. Types of registration: we have the normal registration. Normal registration is what we have described up there. It occurs when a trader who meets the registration requirements apply to be registered for VAT and is duly registered and is given a registration certificate. Second type of registration is voluntary registration. It occurs where a trader who is not qualified for registration apply for registration to enjoy the benefits of a registered person. Then we have compulsory registration. It occurs when a trader who has not been registered applies to be registered to undertake certain business transaction. Such a trader will be issued a temporal registration number. Then we have intending trader registration. This is where a trader who expects to deal with taxable goods and services applies for registration before he or she commences trading. Then we have requirements. Now, once you are registered, you are required to display your registration certificate in a visible position within the business. Now, the following documents are required for one to be registered. In case of a business, you require an incorporation letter. Then we have the personal identification number, that is the PIN. Then we also need a copy of certificate of registration of the business name. Then you also require personal identification number of the trader. Now up here we need to note that we have a separate PIN for the business, and then we have a PIN for the person carrying on the business. Deregistration. Now, registration here means the process of removing a person who has been registered as a VAT person from the VAT register. That means this person will cease to be a member, a VAT registered member. And any person may apply for registration or may be deregistered for one or two of the following reasons. Now, these are the reasons for deregistration. One, the business may close. That means if you cease trading, you have a good reason now to deregister. Number 2 is if the business is sold or it is transferred to another person, then that will be another reason for deregistration. The other reason could be the death of the trader. If the trader dies, then he or she will no longer continue working, and therefore we expect that person to be removed from the VAT registers. Then we have legal incapacitation. For example, the person may become bankrupt. Then we have a reason of insolvency, which is very close to bankruptcy. Then if one falls below the limit, remember when we started the limit was 5 million, and now if you fall below that limit, then it will be another reason for the registration. Now you have to note again, before the registration, any tax outstanding must be paid to the Commissioner of Domestic Taxes. Now once you are deregistered, a trader is deregistered, he or she will be notified of the effective date of the registration, and from that date onwards, that person should not pay VAT. Then the original certificate which was issued on registration is now surrendered to the Commissioner of the Domestic Taxes. Now we have exceptions. Now we have those persons who are required to register even if they have not met the minimum requirements. That means the turnover limit of 5 million does not apply for this type of individuals. Now we have dealers of jewelries, that is number 1. Number 2, we have dealers in timber or sawmillers. Then we have dealers in motor vehicle, spare parts and accessories. Then we have providers of accounting services. Then we have the providers of the arbitration and the legal services. And then we also have any person who sells 4 or more motor vehicles in any one financial year. Now what are the rights of a registered person? Now once you are registered, you enjoy a number of rights, and we are going to look at some of the rights a registered person enjoys. One of them is a right to deduct allowable input tax. That means to offset input tax against the output tax. We are going to look at that shortly. If you are a registered member, you have a right to deduct your input tax, and then you only remain with what you are supposed to pay to the Commissioner. Then we have right to appeal to the tribunal in case of any dispute. Then you have a right to claim for bad debts relief on the refund of bad debts. We have normally those debts that have become irrecoverable, and you know this is a definite loss to your business, therefore you have a right to apply for that. Then to be given assistance in understanding their obligations. Then they also have a right to demand that every authorized officer identifies himself or herself whenever they are coming to carry out the inspection or to do any of their duties. Then they also have a right to have free access to the Commissioner or any other authorized persons. Then they also have a right to expect minimum interference in the business premises. What this means is that the Kenya Revenue Authority officers should not keep on interfering with the operations of the business. Then what are the obligations of the taxpayer? The obligations of the taxpayer: one is to apply for registration. The other obligation you have is to charge a VAT at the right rate on all his or her taxable supplies. Then another obligation you have is to pay input tax. Now for all the registered VAT members, they have to pay their tax. Then they have an obligation to submit the monthly returns to the VAT department. Then also they have an obligation to issue a tax invoice for any supply made by him or her. Then they also have a right to keep full and true records, written up to date, and to retain them at least for 5 years. Then they also have an obligation to allow authorized officers to enter the premises of the business. Now, they normally carry on their businesses. You have an obligation to allow them to enter your premises, and of course they must identify themselves before that takes place. Then you also have a right, an obligation, to notify details to the commissioner of any changes affecting the business. Then they also have to avail records to the authorized officers of the department within the reasonable time for inspection. Then we have what we call group registration. Now this occurs where a company has several group of companies that it is controlling. That means we have one holding company that is controlling a number of other companies. In this case, the holding company may apply to the commissioner to register all the companies under one person. And in this case, all the group members, group companies will continue working, but the VAT will be jointly charged to one person, and in this case, that is the holding company. Now, this is possible and it takes place, but then the commissioner may revoke the group registration if any of the following things happen. 1, there is loss of revenue to the government. 2, one company in the group ceases to supply taxable goods and services. 3, the holding company ceases to control substantially one or more of the companies in the group. So if any of these happens, the commissioner can deregister deregister the group registration. Now we look at what we call the VAT invoice. Now this basically is what communicates the transactions that took place between the sellers and the buyers. Our most important part in the VAT invoice will be mainly the date of the transaction. We need to know when the transaction took place. Then the PIN number of the supplier is given, and then the description of the supply, that is the goods which have been supplied, and of course the VAT rates applicable for them, as well as the VAT payable in respect to the supplier. So it contains that, and it also contains the other items which we can look at down there. It has the name and address of the supplier. And one other thing is that it has to be issued within 14 days from the date of supply. But then you remember that invoice is given whenever we have a credit transaction. In case of cash transaction, then it should be given immediately, should be issued immediately. Then from 2006, the government of Kenya introduced the electronic tax registers, the ETR. Now the ETRs were introduced to curb or to restrict instances of tax evasion. Therefore, the invoice should be generated from the ETR. That is when it is acceptable. Now from there, the taxpayer is required to compute the VAT payable and then subtract the cost of the ETR before making the payments of the tax. Then we have VAT returns. We have the VAT returns. Now we have seen that the registered members have an obligation of paying tax. They also have a right. They also have an obligation of making VAT returns. Now the return has to be done before 20th of the month following which the sales were made. That means every 20th the registered VAT trader is required to make a VAT return. Now, there are cases when the 20th falls on a weekend or on a public holiday or on a day when business is not normally done. In that case, the VAT should be done on the last working day prior to the 20th. Now, there are also cases where the return can be sent via post. In such a case, the required date is 15th, but of course, we have the date when it was posted. When the postmark date was put on the envelope, that is when it was effected. Now, if a trader fails to submit the returns within the given dates, then he or she can be penalized at the rate of 5% of the tax involved, or 10,000 shillings per return. Now the two will be compared, and the commissioner will take the higher. In addition to the penalty, there is also the compounded interest per month, which is at the rate of 2%. Now this is only compounded on the amount that is unpaid at any one given month. Compounding here means that the discounting rates have to be applied on that. Now we look at the records that you are supposed to keep as a registered person. Now a VAT registered person is required to keep a full and a true written record of all their transactions in Kenya for a period of 5 years. Now these records can be either in electronic or in any other form, and they must be in either English or in Swahili. Now the following records are kept. Number one, we have the tax invoices, and they are normally issued in a serial order. That one is important. Then we have the credit and the debit notes issued. Again, these are following chronological order. That is, they follow the order in which they occurred. Then we have the purchases invoices. Then we have the customer entries and receipts. That record must be kept. Then details of imported services. Then we have the tax account. That one must also be kept. Then we have the periodic stock taking records. Then we also have any other record that may be necessary. Now, we look at the classification of taxable goods. The classification of taxable goods. Number one, we have zero rated supplies. Zero rated supplies. Now, these are goods and services that are normally taxed at the rate of 0. That means if you supply them, your supplies will be taxed at the rate of 0, meaning you end up not paying the tax at all, because 0% of any amount you give will always give you 0. Now, the zero-rated goods keep on varying from one fiscal year to another. Now, we can look at this one. Goods which are manufactured for export purposes, like we have the goods which are for EBZ enterprises, they are zero-rated. Other zero-rated goods in our list here will include the goods listed in the second schedule of the VAT Act. So these are some of the goods there which are zero-rated. We have number 2, the standard rate supply. The standard rate supplies. Now, these are the goods and services that will be taxed or will be charged VAT at a standard rate. And in the current financial year, the standard VAT rate is 16% and 8% for petroleum goods and services. But you remember around 2020 towards the end, VAT was slightly adjusted to 14%, and therefore the petroleum products were being taxed at the rate of 7%. But again, we have reverted back to our 16 and 8% respectively. Now, petroleum goods from various supplies will attract 8%. Then we have the exempt supplies. These are goods which are not charged for VAT at all. So meaning that these ones are not going to be included among the goods that are being taxed. Now basically, if you look at the exempt and zero-rated, they are more or less the same. That means the VAT you are going to pay is 0. But then there is a slight difference. If you make exempt supply, you cannot claim for any refund of VAT. So that means it is better to have zero-rated than to have exempt supply because of that aspect of zero-rated, of refund. Then we have a few of the goods which can fall under this class, like unprocessed foodstuffs. We have maize corn seeds of tariff number 1005.10.00, and we also have ambulance services, plant and animal products, and we also have the wooden coffins. Now we have been talking a lot about VAT. Our next task now is to look at how do we compute VAT. To assist us to look at how VAT is computed, I'm going to give you an example here. We have a trader, a manufacturer, Mr. Koech, who is a registered VAT member. Then he purchased raw materials at a cost of 6 million, exclusive of VAT. Then he incurred additional costs as follows: transportation cost, 10% of the material cost. Then we have storage cost, 5% of the material cost. Then we have conversion costs at the rate of 20% of the material cost. Then he later included a profit margin of 25%. Then this trader sold his goods to a wholesaler called Ms. Muikali, who incurred additional costs as follows: transportation costs and the storage costs, 20% of the cost price. Then we have the conversion cost, 15% of the cost price. Then she later included a markup of 33.33% to those goods. Now you are required to compute the VAT payable by both traders. Now, before we look at the computation of VAT, we have what we call inclusive of VAT, and we have exclusive of VAT. So if you look at the question here, you can see that the goods supplied exclude VAT. That means in this price, Koech is not going to, has not been charged VAT. Therefore, what he has paid is just what is going direct to the trader, minus what is going to the person who sold him or her the goods. So for that reason, we normally have two formulas. For VAT inclusive, it means the figure you are given includes the VAT. And if we assume that the standard VAT rate is 16%, therefore, if the figure you are given includes VAT, therefore, it is having 100 plus 16. Therefore, it is 116%. So a figure which is having 116%, it is 100 plus 16. That is why we are getting 116. Therefore, the formula for exclusive VAT is going to be the amount multiplied by 16 divided by 116. So if you are given an amount that is inclusive, if the figure is exclusive VAT, then it's going to be the amount multiplied by 16 over 100. So the first example I've given you is for inclusive of VAT, and here you are given a figure which is exclusive of VAT. So in our current VAT rate, which is 16%, therefore, any amount we are given is going to be 1 over 116 multiplied by the amount. Now, the figure we are given in our example is exclusive VAT. Therefore, the input tax for Koech is going to be 6 million multiplied by 16 over 100. That is coming to 960,000. So the input tax for Mr. Koech is going to be 960,000. Now in our example here, we can now look at the computation of output VAT, because we have been told the input VAT, that is the VAT Koech is going to pay in respect to the goods he has paid, is 960,000. Now how do we compute the output VAT? We have the purchase price exclusive of VAT, which is 6 million. Then we add the services or the expenses incurred. The first expense we have incurred is transportation cost, which is 10% of 6 million. That is giving us 600,000. Storage cost is 5% of 6 million. That is giving us 300,000. Then the conversion cost is 20% of 6 million. That is giving us 1.2 million. Now to get the total cost of the goods supplied to Koech, we are going to add the purchase price plus the expenses. Therefore, it comes to 8.1 million. Now, Koech has added a profit margin of a third. Therefore, to get his profit, it's going to be a third of 8.1 million, which is going to be 2.7 million. Therefore, the selling price of these goods, exclusive VAT, is going to be 10.8 million. Now we have the output VAT. We have the output VAT for Coach. The output VAT for Coach is going to be, in our case, we have the selling price is 10.8, then you multiply by 16%. 10.8 million, you multiply by 16%, that will give us the output VAT for Coach. So when we multiply that, we are getting 1,728,000. That is the output VAT for the goods sold to Miss Mwikali. Now we want to know how much VAT Coach is going to pay. The formula for VAT payable or claimable by a trader is going to be output VAT minus input VAT. The VAT payable or claimable by a trader is the output VAT minus the input VAT. In our example, therefore, for Coach, the output VAT is 1,728,000. The input VAT was 960,000. Therefore, the VAT payable by this trader is going to be the difference between the two, which is 768,000. You can confirm that using your calculators. Now we go to the next one. We now compute the VAT payable by Mwikali. The VAT payable by Mwikali. Now already we know the input VAT is the output VAT for Coach. The output VAT for Coach was 1,728,000, and therefore it becomes the input VAT for Mwikali. That is 1,728,000. That becomes the input VAT for Mwikali. Now we need the output VAT for this trader. We need the output VAT for the trader. In her case, she had purchased the goods for 10,800,000. That is exclusive of VAT. Then she now incurred these additional costs. We have the transportation and the storage cost, which is 20% of that. That is coming to 2.16 million. Then we have the conversion cost, 15%. That is coming to 1.62 million. When you add the two, this is giving us 14.52 million. Then she has added a markup of 33 1/3 to the items she has bought. Now what this means is that the profit margin for her is going to be 33 1/3% of 14.58 million. So when you use your calculator there, you will find the figure is 4.86 million. Now anyone willing to buy these items from Mwikali must pay 19,440,000. That is the cost she has incurred to date plus her profit margin. But remember again, this figure does not include VAT. Therefore, this is not the selling price of the goods to the eventual consumer. we must include the VAT charged by Mwikali before we can arrive at the selling price. Therefore now, we apply our tax rate of 16% to the cost of goods being sold by Mwikali. That is 16% of 19,440,000 is giving us a VAT of 3,110,400 shillings. When you add the two, it gives you 22,550,400 shillings. So this is the price the buyer is going to pay to Mwikali. That will include her price plus the amount of money going to the government. Now, the next thing we have is how much is Mwikali going to pay. We have seen the input VAT for Mwikali is 1,728,000. Then the output for Mwikali is going to be 110,400. Therefore, VAT payable by Mwikali is going to be 3,110,400 minus 1,728,000. So the input VAT 1.728, output VAT 3,110,400. When you less, you get the VAT payable by this trader. And in our question, those who have done very quickly, it's going to be 1,322,400. 1,382,400 is the VAT payable by Mwikali to the government. Now we have the VAT accounts. In the VAT account, we have just put the hypothetical figures there for you. We have one side, we have the input tax. The other side, we have the output tax. Now we have the sales returns. We have over-declared VAT, and we have the bad debts relief, which we have just talked about. Then we have the credit notes to the debtors. We have the debit note from the credit suppliers. Then we are going to add everything there. Then we have the output VAT. We have the purchases returns, the under-declared VAT, the credit note from the suppliers, the debit note from the debtors, and then we have the VAT claimable. The next thing we are going to focus on is what we call the VAT refund. Now, this is a scenario where the government will refund VAT to the taxpayer. Now, these are the various instances when VAT will be refunded. One, where a registered person makes zero-rated supplies. And the other case is where VAT is paid in error, that is, there is an overpayment to the tax authority. The other case will arise in case of bad debts. We have seen the bad debts are a loss to the trader, and therefore it is going to affect the amount of tax paid by him. Then the Finance Act 2015 on VAT refund stipulates that the claims must be launched within 12 months from the date when the tax became due and payable. Now, this was an inclusion because earlier on there were no time limit for the launching of the VAT claims. But however, you note that from the government side, the time for repayment or resettlement of the claim is not limited. Therefore, it will take a lot of time to do that. Then we have restriction of input tax. We have restriction of input tax. This takes place when you find that a trader is buying goods at maybe zero rated and a standard rate, but then when he's applying as taxable and at the same time exempt, and the others are zero rated. So we have a scenario where at the purchasing section we have zero rated and a standard rate. At the selling we have standard rates, zero rated and exempt. Now we have two methods which are used. We have the proportional method and the allocation method. Alright, I want to use that example there. Mr. Kamau is a registered trader, and in the month of March 2015, he supplies the following information. Sales at a standard rate 45 million, zero rated sales 30 million, exempt sales 15 million, purchases at standard rate 30 million, zero rated purchases dash. Then we have cost of stationery, we have 120,000, cost of an ETR 320, and then we have electricity bill, that is 60,000. Then compute the VAT payable by Mr. Kamau for the month of March 2015. Now in that section we have the computation of his output VAT. The computation of his output VAT. We will have three columns. We have the nature of supply, the amount involved, and then the VAT. Now the goods which are supplied at standard rate were 45 million. Therefore you multiply 45 by 16%, is giving you 7.2 million. Zero rated goods were 30 million, and of course we know 0% of 30 is giving us 0. Then we have exempt. Exempt is 15 million, that is giving us no tax. Therefore the total amount involved 90 million, and the total tax there is 7.2. So we can say therefore for Kamau, the output VAT for Kamau $7.2 million. The output VAT for Kamau there is 7.2 million. Then we look at the computation of the input tax, that is purchases plus expenses. Zero rated purchases 24 million, which is coming to 0. Standard rate is 30 million, is giving us a tax of 4.8 million. Then stationery 120, you multiply by 16%, is giving you 19.2. Then electricity 60,000 is giving us 7.2 million. Therefore the input tax is 4.8. 4,826,400. Now we have what we call the deductible input tax. We have a formula. Taxable supplies, you divide by the total supplies, you multiply by the input tax. In our case, the taxable supplies were 40 million plus 30 million. The total supplies were 45 million plus 30 million plus 15 million. Then once you divide that, you multiply by 4.826, 400. It is giving you a deductible input tax of 4.022 million. Therefore we can say the VAT payable by Kamau is 7.2 million minus the deductible that we have got there, which is 4.022 million, 4.22 million, that is giving us the VAT payable by Mr. Kamau, which is 3,178,000 178,000. 3,178,000. Now, if I take you back there, you will notice that we have the cost of ETR 320, which is refundable. Therefore, you minus 320 from this figure. That is going to give you 2,858,000. That is now the actual tax paid by Kamau will be 2,858,000. Now I want to give you a question which we are going to work on. Bingwa Limited wheat flour, then it has a rental income from its commercial property within the same premises. Bingwa Limited earned the following income in the month of July 2016. Wheat flour sales, Kenya shillings 10 million, rental income 400,000. During the same month, Bingwa Limited outsourced transport services from Warumi Limited. Warumi Limited raises an invoice of 1 million shillings for its services. Then, in addition to the above, Bingwa Limited received 2 invoices from Kenya Power and Lighting Company of Kenya shillings 1 million related to the factory, whereas 50,000 was incurred on the commercial property it rents. Bingwa Limited also requested Nadal PLC, a company based in India, to provide it with advisory services for a proposed venture they could like to undertake in India. Then Nadal PLC billed Bingwa Limited Kenya shillings 500 for the services. Now you are required to determine the VAT payable by Bingwa Limited for the month of July 2016, and if you successfully do that, you will get 8 marks. That is the end of our lesson today. We meet next week for the same, a continuation of the same. Thank you.